Hi, Ron here with Leppy the Leopard, my mascot. Welcome back to my channel on saving money and taxes. And so this video is to go over some of the tax strategies that you need to do before the year ends. It's November 21st that I'm doing this recording, so we have a little over a month to do some tax strategies. So listen very closely and rewind the video if you have to. Of course, email me and we can set up a phone appointment to do consulting on it. So let's start with one of my favorite pet peeve deductions is to use the pre-tax retirement plan that your employer offers you. And this is if you're employed, W-2 employee, and you have that available at your work. Now, sometimes you might think, well, gee, I need that money for my to use for my daily needs or monthly needs. So I can't put money away in my retirement account, or I can't put in a lot. Well, just remember what you're doing. You're saying to yourself, I have money to pay the IRS, but I don't have money to pay myself. Okay, let me say that again. You may be thinking you don't have money to put in your retirement account, but in essence what you're doing is saying, I have money to pay the IRS, but I don't have money to pay myself. Okay, so remember that when you get thoughts like that the pre-tax retirement account is your money. Win-win. Remember to watch my videos on using the pre-tax retirement account plan at your workplace as a way to reduce your taxes. Now, I'm saying all this, you can watch the video. I'm saying it in this video again because you need to do it before the year ends. So if you haven't maximized it, then you need to do it before December 31st to get credit for it, to lower your taxable income on your W-2. It's what you show us, right? You show us tax accountants your W-2 that you get from your employer, and we use that to do your tax return. Well, if you want to lower your taxable income, which is reported on box 1 of your W-2, then you need to make any more contributions by December 31st. And I suggest doing the maximum amount because, again, I know you're thinking I don't have the money to do that, but what you're saying is I have money to pay the IRS, but I don't have money to pay myself. So if you can, maximize the contribution limit. The contribution limit changes from year to year. The contributions on pre-tax retirement plans like your 401k, 403b, or thrift savings plan is higher than a traditional IRA. It's almost double, and maybe sometimes even triple that what's offered in a traditional IRA as a contribution limit. Okay, so do that before December 31st. Go to your employer, your human resources, your employee benefits manager, whoever is handling your pre-tax retirement plan account, and tell them, hey, I want to put in the maximum amount I'm allowed to for this year. This is 2020 now. It's any year. All these things I'm talking about, unless the law changes drastically in this case, will apply to any year. So if you want a higher tax deduction for your 2020 tax return and you have a pre-tax retirement plan available at your employer, make sure you're contributing up to the limit. And if you're age 50 and over, you have a higher limit. And remember, another benefit is most employers are matching. Not dollar for dollar, but they might put in a percentage of what you contribute into your account. That's a win-win, okay? Because that money for your retirement plan is not coming out of your pocket, it's coming out of your employer's pocket. So use it. Remember, this doesn't eliminate the tax, it defers it till you're in your retirement years and you're taking money out, let's say on a monthly basis. Then the tax is only on the amount you take out. Okay, the next strategy to use is your itemized deduction schedule, also known as Schedule A. I know some of the schedules changed in 2018 when we went through a major tax law change in 2018, but it's commonly known as, in our profession, as the itemized deduction schedule. And that's where you get to take medical expenses, sales tax, property tax, mortgage interest, charitable donations. That's where those are reported. Now, medical expenses, if you have medical bills that you can pay off this year before the end of the year, then do it, and it may help you lower your taxes and may increase that itemized schedule deduction and put you over the standard deduction limit. Remember, the itemized deductions has to exceed the standard deduction the IRS gives you in order for it to count. Okay, and the standard deduction is determined by your filing status, meaning if you're filing single, married filing separately, married filing joint, widower or widow, or head of household. So the standard deduction, and your age. The standard deduction is based on those factors. So if your itemized deductions exceed the standard deduction, you get to use the itemized deduction. So that's why I'm saying, if you have medical bills that you can pay and they're high and you can pay it in this year still before December 31st, then do it. And if it exceeds 7.5% of your adjusted gross income, that's the first threshold, then you get to count what exceeds the 7.5% of your adjusted gross income. Now, what's considered medical deduction? I know we're calling it medical, but it's medical, dental, eyeglasses, long-term care, insurance. So you have a bunch of deductions. If you're not aware of which deduction is available to use, then you email me, and I can email you back a list. But you got to do this by the end of the year. So the next deduction is the sales tax deduction on the itemized deduction schedule. If you've kept your receipts from everything you've purchased and add them up and you send them to me, the total, I just need totals, remember. I never need, just to allude to this for a minute, I never need to see your original copies of your tax documents, your W-2s, your 1099s that you get, and what you add up in receipts. Especially with the receipts, I just need totals. Your W-2s, I just need copies. 1099s, I just need copies. I've been doing remote tax work for many years, even before COVID came along. I was doing tax preparation remotely. I have clients in other states, and we use technology. We have technology. We have email. We can scan things. We can fax things. We can even take pictures on our phone of the tax documents. My clients have done that for me. So anyway, if you've kept track of your sales taxes that you've paid, then total them up, and then when you send it to me, I'll compare it to the standard the IRS gives you of a sales tax deduction. And if yours is higher, we get to use the higher amount. Now, in addition to the normal sales tax on purchases, if you've made major purchases, like you bought a boat, you bought an RV, you bought a vehicle, and you've got sales tax figures on that, I can add them to the standard or the amount you give me. Okay, so the IRS does allow that. It allows you the better of the two deductions. If yours is higher, you get to use your amount. Okay. Now next is the property tax. And before I cover property tax strategies, you have to know that in 2018, the tax law changed on the amount you can deduct for sales tax and property tax, and they limited it to $10,000. $10,000, the limit of the sales tax and property tax combined. But don't let that stop you, okay? If you can pay, if you know you're going to possibly subject to a higher tax on your 2020 tax return, a strategy you can use is pay 2 years worth of your property tax in the same year. So this is 2020. If you've got your property tax bill for 2020 that you haven't paid yet, and you've already got your property tax statement for 2021, well, think about paying both of them this year in 2020, because remember, it's when you pay it, the year you pay it in is the year that it's deductible for. So this is a scenario I run into with my clients. You show me the property tax bill, and then I look for when you paid it. If you paid it in the following year, we can't count it in the current year tax period. So make sure, if you want to count that property tax, and we'll just use this year's 2020, but it works the same every year. If you wanted to count for 2020, pay the tax bill, the property tax bill in 2020. And like I said, you can double up. Pay 2 years worth, 20 and 21's property tax bill before December 31st for it to count on your 2020 tax return itemized deduction schedule. Okay, moving on to the next deduction. It's on the itemized deduction schedule. It's your mortgage interest. Now, thankfully, as far as I know, they haven't capped the mortgage interest deduction like they have capped the property tax and sales tax deduction. Anyway, so again, with mortgage interest, you really don't have a choice. That's pretty much, it's paid when you pay your mortgage, right? But what if you double up on it? What if you're using one of those accelerated versions to lower your mortgage, okay, by paying it off sooner, or doubling up on certain payments? Well, that's a good strategy also, okay? So if you plan on paying, like say December's mortgage payment, and you plan on paying twice the amount, well, guess what? That increases your interest deduction, because you just paid, especially if you're paying a lot of interest at this point, you just increase your mortgage interest deduction. Now, I just use 1 month as an example, but let's say you do it for 3, 4 months, 5 months, 6 months. That mortgage interest deduction is going to be pretty high, and you can use that on your itemized deduction schedule. Now, what some people forget is that if you're buying a boat and it has a bed, a toilet, and the kitchen, same with your RV, bed, toilet, and kitchen, that counts as a second home. Isn't that great? So okay, so if you've got interest payments on that purchase of your boat, your RV, that counts as part of your mortgage interest. So you can actually take a mortgage interest deduction on that RV and on that boat as a second home. Okay, and it has to meet those three requirements. It has to have a kitchen, has to have a toilet, has to have a bed, and then it's considered a second home. Okay, the next deductions are your charitable donations, whether it's cash or non-cash. So again, if you want to lower your taxes, increase your tax deductions, then think about doubling up on the charitable giving, or increasing it. Okay, but remember, it only counts in the year you make that payment. So if you get a request for a donation in 2020 and you donate in 2021, it's not going to count in 2020. It's going to count for 2021. All right. Please watch my video on using a charitable gift annuity. Charitable gift annuity as a way to increase your charitable giving, your charitable donations, to get a higher deduction, to exceed that standard deduction and make you more eligible to use a higher deduction. Okay? And I've thrown a lot of things at you, and don't be confused. If you are confused, okay, that's normal. And just remember, you're not the tax guy. I am. I'm the tax preparer, and that's why you come to me, so I can increase your knowledge and also give you these ideas. But you have to do it timely. You have to ask me questions before you make a transaction, before you do something, or before the year ends. There are ways to avoid, like the penalty for early withdrawal from a retirement plan. If you're younger than age 59 and a half, you get slapped with a penalty if you take money out of your retirement plan or an annuity. So I can tell you ways that if you need money out to use for whatever, you need money to buy a car or improve your home or whatever, and you're going to tap into your retirement plan. There's ways to get funding without taking that hit on your tax return, the penalty tax for withdrawing it early from your retirement account because you're younger than age 59 and a half. I had a situation happen with a client in California. They told me what they did, but it was too late. They already did it. And if they would have just called me, don't be afraid to use our services, because you do have to pay for our consultation and our advice, but remember, we could be potentially saving you thousands of dollars. Okay, so there is a benefit for using us tax professionals for good advice that will save you a lot of money. Okay, so don't be afraid to call, especially if you're a business. My fees are tax deductible to you as a business expense. Okay, just remember that. And talking about business, if you watch my videos or you talk to me on the phone and we consulted and I helped you set up your LLC or S corporation, you have the ability to set up a 401k. If you remember, I talked to you about that on our consultation. I mentioned that you can set up a retirement plan for yourself as an S corp. You're an employee of yourself, of your S corp, and that entitles you to a 401k plan that you can use and take a further deduction other than the tax savings you're getting from converting from a sole proprietor or from a single member LLC to an S Corp. I go over that in my other videos, so I'm not going to get into detail now. I'm just reminding you, if you took my advice and you set up your 401k plan for your S Corp, you got to get that funded. You have to get it set up and funded before December 31st if you want to take that deduction on your tax return. Okay, so I covered a lot of things and I might have gone pretty fast, but I wanted to make sure that you know you have strategies that you can still use before the year ends. And you need to get them in place before the year ends. The other strategies that I've mentioned are in other videos. And so you want to take a look at those other videos I have, such as a 1031 exchange to defer capital gains tax on the sale of a business property. Watch my video on that. Again, if it's a deduction you want in this year, you have to get it done this year. And the 1031 exchange is regulated by the IRS. The methodology you have to use to accomplish that is spelled out by the IRS. So, and it has a time signature on it, meaning, yeah, there's a time limit. So if you have a property you're going to sell still here in 2020 and you want to defer the capital gains tax on it, get a hold of me. Also, a reminder, if you have to watch, one of the things I see is that, and I know it's time consuming, but if you're not watching what your investment broker or financial advisor is doing, and then you show me your 1099 consolidated 1099 from your brokerage firm, and I see all these stock trades and bond trades and whatever mutual fund trades, and then you're hit by this huge capital gains, which will be subject to capital gains tax. You need to watch and look at your statements you get from your brokerage firm to see what activity is going on. So you're not surprised. Like I had a client this past year, surprised with a huge capital gain, which is great because he made a profit on the sale of some of his stocks, bonds, mutual funds, whatever. But he wasn't prepared to pay the capital gains tax on it. So again, these things must be done before it happens. So look at your if you're getting your brokerage statements monthly or quarterly, look at them. And if you need help to look at it, consult with me. I'll take a look at it and I'll tell you, hey, do you know that your broker made this trade, and at the end of the year you're getting on your 1099 that's reported to the IRS as well, it's going to show a capital gain which you're going to be taxed on. Are you prepared to pay that tax? Okay, because at that point we could say, okay, tell your broker to stop making trades, so much trades, even though he's making you a profit, or we'll catch it in time so that you can plan ahead and put money aside to pay that capital gains tax. All right. There's also strategies with investing for tax savings. All right, and there's other tax strategies. You need to, again, watch my other videos, but I just wanted to get this in before this year ends, because it's November 21st, to get you to make some moves now to increase your tax deduction and lower your taxes. All right, thanks for watching. Please subscribe and stick with me if you want to save thousands of dollars on your taxes. Bye bye for now.